But let's take a deeper dive into this market to answer many questions that I know our viewers have. So joining me now is Kevin Gordon, Director and Senior Investment Strategist at Charles Schwab. Kevin, welcome to the show.
Good morning. Good to see you.
Good to see you as well. So we see some fractional gains in stocks coming off a pretty strong week. What's your current investment thesis?
So, the thesis has been that, for the year, the broader market can do well, but not without some bifurcation. So you're still seeing it, whether it's large cap versus small cap, parts of cyclicals versus parts of defensives. But it's interesting, even if you look at the profile and the leadership profile since the most recent peak for the S&P at the end of March, it's been this mix of defense, growth, and cyclical, meaning the only three sectors that are up are energy, communication services, and utilities. So, as of now, I think the performance over the past month hasn't really told us much about what leadership is supposed to look like, because I would argue all three of those sectors are rallying for different reasons. Energy probably because of the commodity rally, utilities because got so deeply oversold last year, plus there may be a little bit of an AI narrative there, and then comm services, you really have such mega cap dominance with the two main drivers being Alphabet and Meta. So I think that right now you're not getting as much of a near-term, maybe narrative clarification, but more broadly with earnings still strengthening, with sort of monetary policy, I think in gear right now, meaning we're on pause. We know that the next move is probably a cut, even if it's pushed further out. That sort of still sets you up, I think, for a pretty favorable backdrop.
Does the Fed's sort of repricing of rate expectations that we had seen based on some of the commentary several weeks ago impact things at all?
So I wouldn't call it, Fed repricing. I'd call it rapid and aggressive market repricing, because if you think about, just to the beginning of this year in January, what the expectation was on the part of the market was that we were going to have 6 to 7 cuts this year. So that's a fairly aggressive cutting cycle for the Fed. At a time when, maybe inflation was looking like it was trending closer to the Fed's target, but you hadn't yet gotten confirmation that the labor market was in check for the Fed to start cutting. So the Fed, in that entire period from now January to now, where the market's pricing in maybe 1 or 2 cuts this year, they haven't changed their tune. They've always said, we could hike if inflation reaccelerates, we could hold for longer. If it takes longer for inflation to come down, we could cut if there's unexpected labor market weakness. So they still have kept all three options on the table, haven't really changed their tune in terms of what they're looking for. And if you think back to, December, January, what Powell was saying in particular at press conferences, it was more about looking for more of the same of what they had been seeing on the inflation front. Now that we have January, February, March data under our belt, we know that that's not the case.
Is the recent GDP report that we saw last week, which many traders dug down here as stagflation, slower than expected growth, but still growth a bit above 1%, and inflation still above the Fed's 2% target. How do you view that?
So I think if you're going to talk about stagflation, maybe in a 1970s style, sense of the term, I wouldn't say we're there yet, because in that era you had high unemployment plus high inflation. We do not have the unemployment component satisfied today. You're still at 3.8% for the unemployment rate. So I think that you can rule out stagflation in that sense. Second thing is, even if you go kind of to the meat, in the details of GDP, the components that dragged us down to the 1.6% annualized rate were just net exports and the private change in inventories. Not that those are to be completely ignored, but if you looked at the underlying strength for consumption, for business investment, both of those were still strong. Consumption driven, largely by services, business investment, a lot of sort of intellectual property investment holding that up too. But if you lump those two categories together, that real private sales to domestic purchasers, very long way of saying just sort of underlying consumption and investment in the economy was still strong at 3%. So I think that component would need to come down meaningfully, with inflation staying higher, for it to be more of a stagflationary environment. But I don't think we're there yet.
Certainly, we have seen corporate earnings be quite strong, right? And so I agree with you. I don't think that narrative has changed at all. But it is interesting to see how dramatically the stock market will move based on Fed official comments if their rate path does change. I think some people thought the Fed maybe caved to market expectations in December, granting 3 rate cuts or forecasting 3 rate cuts, and then maybe came back a little bit down toward reality. But it sounds like holistically, even if the Fed does push back these rates, that you are still bullish at Schwab.
Yeah, because I don't think that, the Fed's policy path is going to be the main determinant for the market. I mean, even if you look at prior periods when the Fed was in pause mode, you go back to all 14 Fed cycles where you had the increase, the rate hikes, you had the pause, and then you had the cuts. In those periods, from that time span of final hike to first cut, the market was up in 7 instances, the market was down in 7 instances. So that tells me that it's basically a coin toss. You have to look at the underlying economic data and whether there's going to be strength. So that's why we're not putting so much weight on what the Fed does when the first cut arrives, how many cuts it's going to be. Because I think as of now, for now, we know that the next move is a cut. We don't expect cuts to bring us back down to the zero bound. But even when they do cut, I think you have to look at the economic data at that point. That tells you what the health of the market's going to be. So, my knowing or our knowing if they were to cut, tomorrow or this week, that would mean nothing to me if I didn't know what the underlying economic strength was.
And so knowing that, where do you see opportunity in this market?
So we're still in the camp that, assuming that you get, which all indications are still at this point, that you get, a slow cutting cycle. So call it, 5 or fewer cuts in a 12-month span, which seems to be the case where this Fed wants to go. If that's the case, history is relatively consistent with the fact that you do see outperformance from the broader cyclical categories. So basically everything that's not utilities, real estate, sort of healthcare staples, so your energy, industrials, tech, communication services, it's a broad net, but that category tends to do well when you're in a slow cutting cycle. So that's what we'll stick with. And it's reflected in our sector ratings too. We've got an outperform at energy, materials, and financials. So it's more biased towards deeper cyclical and value areas.
And so it also sounds to me like it is a broadening out, right? Because we've seen the Magnificent Seven lead for so long.
Yep.
And certainly the NASDAQ, has a higher beta, so it's fallen more these past few weeks, even though last week it was an outperformer.
Yep.
So it sounds like tech might take a bit of a back seat, can still grow, but maybe not as much as these other sectors.
Yeah, and it already has to some extent. I mean, if you look at the performance again from the most recent March peak for the S&P, tech has been near the bottom of the leaderboard. It has been sort of comm services, energy, utilities outperforming. Not that that lasts in perpetuity, but I think that you've seen enough of a leadership shift and a rotation under the surface where some of the names that didn't participate in the rally last year, given last year's was so narrow, so driven by just a few sectors and a few names, now you're finally starting to see them participate, and we would argue that's a really healthy sign for the market.
I do see small caps outperforming a little bit today. They had some good days last week as well. Can we finally see a bounce in some of these poor small caps?
It's tough for the broader index to rally. I think you need a lot more interest rate volatility coming down. More clarity, I think, on the actual trajectory of where the Fed is going, because small caps are more tightly hinged to, I think, what's going on in the interest rate environment. But even within small caps, there have been pockets of outperformance. If you look at industrials, even if you look at tech to some extent, what's really dragging it down has been weakness in healthcare and consumer discretionary. Those are huge weights in the Russell 2000. So I think the math for that index is just not as favorable as something for the S&P.
For a viewer who's watching and wondering, well, in this environment, the economy seems like it's humming along, relatively speaking. The Fed interest rate path eventually will get rate cuts, but they might be delayed a bit.
Yeah.
What's a risk tolerance level that you think would be appropriate maybe for our viewers?
Well, it depends on the investor, and it's tough because, you and I were chatting a little bit before we went live about where we are in the cycle right now. Is it early cycle? Is it late cycle? There's so many mixed signals because if you look at something like manufacturing or CEO confidence or some of the more survey-based data, you've gone through sort of a recession phase, and now you're entering a little bit of a recovery phase. Vice versa, if you look at something like the labor market or services, you could argue that we're still showing late cycle behavior. So the nice thing about that is that with rates still staying elevated, you're in an environment now where staying up in quality really pays, meaning companies that have high interest coverage ratios, so they can weather the interest rate storm better, those that have actual strong profit margins. We were talking about earnings season, so what their outlook is for guidance in the future. If you're taking a high quality approach that way and applying that to every sector, we think that you could do well. And I think that's an important thing to note, just because when you tend to go into sort of early cycle, it happens when rates have come down significantly, but we haven't gotten that yet, meaning low quality, high beta parts of the market probably won't do well in the near term.
All right. Kevin Gordon, Director and Senior Investment Strategist at Charles Schwab. Kevin, thank you so much for joining.
Good to see you. Thank you.
You too.